interesting, and I'm sure Tom will comment on this, was if we look at the weekly chart, one of the things I look for, and for a major market move, so let's just get straight to the point, is I look at trend lines. And I'm sure Tom will tell you the importance of trend lines, because they are, for me, my guiding light in the market. They show me almost like a playing field, if that's the right word, where you have support and resistance. I used to play football, soccer, for those of you in America. Of course, it's big in the news at the moment, soccer, with what happened to Brazil. And, you know, you've got two goals, haven't you, that each side attack. You've got a halfway line where you've got a clear delineated line. You've got a penalty area, which is delineated with a line. Well, do you know something? Sport and trading is not a lot different, really, sometimes, because what you're doing is here we're delineating certain areas of the chart where we expect to see strength or weakness. And the lesson that I learned from Tom, which actually still surprises me today, is that strength appears on down bars as the market falls to the lower trend line. And conversely, as we saw this last week, weakness appears on up bars at the top of the trend line. Now, I spoke with Tom earlier. We've both been invited as guest speakers at a very big event in Barcelona in September. And I was talking to the organizer earlier. And one of the things that's become very apparent about the work of Tom Williams, Richard Wyckoff, and my book and my work is that it's now gaining massive ground. More and more people are finding it. And today, I learned for the first time, there is a Spanish website dedicated solely to price and volume based on Tom's book, which is incredible. So it's amazing. Tom always said to me, once you've written a book and the book's out there, people come knocking on your door. Well, that's exactly what's happening all over the world, not just in one or two countries. Now, I want to explain very briefly before I ask Tom to analyze this chart what I see here. Remember, strength appears on down bars, okay, which it does. I mean, you've got a massive widespread down bar. This is a weekly chart of the E-mini S&P. And the next bar reverses to close up near the high. Now, this is what we call a two-bar reversal. Okay, we haven't got any signals on the weekly chart, but we did on the daily chart. And as a result of that setup, the market, if we look at Tom's simple trending system, which says an up bar, which is a price bar that closes higher than the close of the previous bar, we put them blue in my particular software. You can color them any color you wish. If you've got Trade Guide, there are ways of customizing it, but I use blue. You can see we have an up bar. The next week we close higher. The next week we close higher. We have a down bar, but look at the volume. Narrow spread buying takes place. The next week an up bar, an up bar, an up bar. And we're always approaching this uptrend channel that's been in place for several months. We have a down bar, but the volume isn't particularly high. So there's no selling pressure in the market. Up bar, a down bar, narrow spread, and then a big up bar. But this time, we've come up to the top of the trend line. Now, here's the key. This bar came in the week before the Federal Reserve was about to make an announcement. And professional money are fully aware, and Tom will confirm this, of what the announcement's going to be. So they already know that this market's getting tired up here, and they're going to want to buy lower, because that's how you would want it. You'd want to buy lower. So at this moment in time, I'm expecting a pullback and to the low of this bar, okay? And actually, I'm already positioned, and when Tom finishes, I'm already positioned in a trade here, a live trade, because today we usually do a live trading room, and I combined it with Tom's event because I wanted to see Tom's view of especially gold and also the S&P and the euro. So, Peter, those are the three markets that I know we've got a lot of interest in right now. So, hello, Darren. Nice to see you. I'm expecting a pullback to test this bar here. And I don't know if Tom will agree with me, but there's high volume on an up bar here. And if we look at the low of that bar, it's at 1919. Markets don't like high volume, although I have to say it's not as high as I'd like to see for weakness. And as Tom observed earlier when I was talking to him, he said, well, Gavin, there is no end of a rising market here on any of these, even on the daily. There's no buying climax. So this could just be the market taking a breather and having a rest. So without further ado, please let me welcome Tom Williams. And for those of you that are new and have just come in, Tom is the inventor of volume spread analysis, and he'll probably give you a few minutes summary of exactly what that's about. All the best, everyone, and I'll hand over to Peter and Rita and Tom to carry on, and then bring me back in when you're ready, guys. Over to you.
Okay, thanks very much, Gavin. Right, I'll just put Tom's screen on for everybody to see. And the chart you'll see in front of you is the Dow. Now, Tom, do you want to look at the Dow or do you want to look at the S&P?
Well, we'll look at Dow for now.
Right, we're looking at the Dow first. So, of course, the Dow and the S&P are linked together. The Dow, of course, forms part of the S&P. So, I'll hand you straight over to Tom Williams.
Yeah, hi everybody, Tom Williams here. Thank you, Peter. Thank you, Rita. Right, okay, so Gavin says we have quite a few newcomers to volume spread analysis. So I'll give you a very quick rundown on what it's really all about. Now, of course, lots of people use fundamental analysis, where they send experts out to the various companies and delve into their books and all this type of thing. And they come up with an overall view which they let the big trading houses know about. Well, we all know about that. And the other one is technical analysis. Now, we don't use any mathematical formulas at all, right? We look at what we call supply and demand. Supply and demand, as far as we're concerned, what we know it is caused through professional, there's an army of professional traders who think nothing of throwing 50,000 contracts into the arena. And it's this, putting all these contracts in or withdrawing them or selling them, that creates supply and demand. And the chart, you can actually read most of it. Now, admittedly, to somebody new, it does take some time to get your head around this. And the reason is that whatever you hear or see about the stock market is probably lying to you. Now, it's a funny statement. You say, oh, no, the stock market's well organized. It's not. Well, it is organized, but not organized in your favor. And we can show you that I always say never believe anything you see or read, especially on TV, about the stock market. And it's that causes the problems. But what we say, or what I say, is that these charts are a language talking to you, speaking to you. And once you learn to read them, right, you'll have that skill with you for the rest of your life. And you will never, ever regret it. Now, why don't we use any formulas, mathematical formulas? Now, admittedly, they're in the program, and a lot of them, because that's what people wanted in days gone by. But what I say is that if there was any positive results that you could expect from a mathematical formula, keep in mind that there's some very, very clever people out there. Not only are they very clever, but they've also backed with big money. And if there was such a thing as a simple formula that would indicate whether the market was definitely going to go up or down, believe me, they've been onto it years ago. And the fact is, as soon as this formula started to develop, they would trade it out of existence. And it wouldn't be there for you to look at in hindsight. That's my opinion, of course, and I think that's what's going on. And that's why we can't rely on any formulas whatsoever. But you can rely on supply and demand. Supply and demand is created by the professional players in the background, right, throwing in 50, 100,000 contracts, which they do, huge amounts of money, but we can see them doing that most of the time. And also when they sell, we can also see them selling. Now, the program we have here, it comes up with what I call automatic signals. This is what I developed from the basic knowledge of Wyckoff, right? And now the thing is that if you've got a program with automatic signals, that's fine. But if you look at it and think, well, they're not bad, they're quite good actually, then you've got to realize that computers do not understand flaws in your thinking, flaws in your logic. You've either got it right or you haven't got it right. And therefore, if you think they're quite good, then you must realize that we don't hold any secrets back to you, from you. We tell you everything. We tell you even how the signals are formed. So it's very, very interesting. But once you learn to read these charts and get your head around the fact is that most of the time you're being lied to if you listen to the TV, read the newspapers and all the rest of it. They don't lie to you deliberately. They just don't understand. They don't understand what drives the market. Now, why that is, I don't know. But there you are. But now, what we've got up at the moment is the Dow Jones. Now, the Dow is part of the S&P 500. So what the Dow does, the S&P 500 does. Now, the reason why these daily charts, which this is important to us, is it gives you a very, very good idea. The general trend of the market is like a roadmap. If you're going to jump in your car and go off around Europe or somewhere, or America, right, you need a roadmap, some idea of where you're going, and so on and so on. And this is why we draw trend lines here. The traditional way to draw a trend line is if the market is rising, you draw the line under the first 2 points of support and then move it up to the first point of supply. And that's projected way out into the future. Computer can see and read all this, and it'll come up with what we call trend clusters, which is interesting too. That's another very interesting subject. Some people love them. I personally don't use them because I feel I can read the charts just as well without them. But anyway, this is the Dow Jones here, and it looks to me that this market is trying to go up. You can see clearly the trend is up. This last bar, look, it plummeted down, more or less met the trend line, right? But it bounced off and closed in the middle. And the volume is sort of just average, look. That to me looks as if the market is in fact trying to go up. Now, when I usually describe a chart, I tend to specialize more in very short-term trends, because what we like to do in the office is do a bit of what we call scalping. In other words, you put a trade in, you can make a few $100s, close it out, and as I say, go and have a cup of tea or something. Okay? Now, if you are running or looking after your pension and so on, then of course you need to look at the weekly charts, even monthly charts. And it's the same principles at work though. Right. Now, are there any questions about this?
Can we look, Gavin's asked if we can look at, or you can look at gold.
Gold, yeah. Go on, they put gold up. Daily, so all we got is a daily chart of gold. Now, the thing is, gold, apparently, well, what it traditionally does, if the S&P 500 is falling, then gold goes up. If the S&P 500 is going up, right, then gold falls. Traditionally, that's a guideline. Okay, now obviously, the Dow fell here, and this is what made the gold chart go up. Now, what we're fully aware of is, see these red test bars? We call this a test bar. A test is testing for the amount of supply in the market. If you're a professional player and you've got thousands of contracts on the go, right, you have to make sure, right, for your continuous support in that direction is that there's no supply present. And a test, we call this, there's no signal on it, unfortunately, on this daily. But there will be on different time frames. A test is a down bar. A perfect test is a down bar, narrow spread, closing middle or high, and the volume is low. That means the volume is low because there is no professional selling there to worry about. Now the computer analyzes that bar for us, and if we look down at the bottom here, it tells us bar is down, volume is high, spread average, closed middle. Now that's not the perfect test, but it has closed in the middle, right? Spread is average, volume is high, so there must have been some support there. So when they marked it down, look, they came in and did a bit of buying, and that buying forced the test bar to close near high, and that's what gave it impetus to go up. Interesting it is. Now, as soon as you see that, you know fairly certain that you're going to get higher prices. Now, here's another red down bar here, and we have at the bottom, what's that say, Peter?
Test.
Yeah, okay, a test. That's another test, look. And next bar, all right. Although it's a red down bar, you can see it's almost trying to go up here, look. But there is supply there. I would not be surprised if gold doesn't hesitate, come off a little bit. But there's nothing dramatic there to say it's going to go into a bear market. Bear markets, we haven't seen that in the S&P or Dow yet. It will eventually, you'll see an up bar, right? It may be gapped up, and the bar may be narrow spread. If you see that, especially if it goes up into new high ground, but the volume is massive, very high, you can bet your bottom dollar that is the top, and that will come up with an automatic signal. We call it the end of a rising market. Now don't forget, these signals will be running for years, 10, 15 years they have. and they have not been altered, and they will continue for the rest of your life acting the same way, because this is how the markets work. And you'll see the top of the market will be topped out with this end of a rising market signal, or what we call a buying climax. Buying climaxes have been going on for hundreds of years as the market top. You see a huge widespread up, right? It'll close in the middle. You look at the volume and it'll be massive, very high. If it's up, oversold, that is above the trend line, you can bet your bottom dollar that's the top. So there are two signals that will mark the top of a bull market, and we haven't actually seen that yet.
Next one, Tom. Will you look at the euro? Just put it up.
The euro, right? Right, the euro. Well, it's oscillating up and down a bit. Peter, you could draw trend line between there, and there. I always like to draw trend lines. First two lows, first high. There. No, there. That's it. Okay? So we can see that this market is in fact trending up at the moment. Here, of course, it's over bought. I don't normally trade gold. Gavin's into gold more than I am. Oh, the euro, I mean, sorry. But this market appears to be wanting to trend up. There's nothing outstanding that I could see at the moment. We've got a sign of strength appear here. If you put the cursor over the signal, press F1, yeah, it'll tell you why a signal has appeared. Now, we don't hold any secrets back. We tell you everything we know. And we've written all this down in these dialog boxes, look. And if you keep studying these dialog boxes, and there it tells us the reason why they've gone up a bit is because there's no supply present at that point. Markets work on supply and demand. It's been marked down, look. The volume has to be low. That means that the professional money interested in this instrument is not selling. If they're not selling, they must be bullish at that point. Okay? What else do you want? Put the
have a look at gold, please. Gold. Yeah, have a look at gold.
Yeah, can you tell Gavin we've looked at gold already?
Oh, okay, that's fine. Sorry, I was out for a second. That's fine.
Gavin?
So, yeah, no problem. That's fine. So, one more thing. Could you look at the British pound and the US dollar, the pound dollar? Because I've got some a trade on that I'm about to do an alert on.
Pound dollar. There's the pound, Tom.
Right. Well, the pound has hit the top trend line, look. Notice that there is an increase in volume. Nothing excessive, though, but it's definitely an increase. There, look. Professional money would see that immediately, and the next bar is up. It's up though on a narrow spread. Now, narrow spread tells you definitely, especially at the top of the market like this, that there must have been a lot of professional selling there. Every time a buy order came in, right, it was satisfied, and that creates a narrow spread, right? A little bit of volume comes in. Then we have what we call a no demand up thrust look. Now, no demand is interesting. It's gone up, been marked up deliberately, look. But when we look at the volume and we see it's low, and it's occurred after weakness appears, when it appears on up bars. And the reason is that if you hold vast quantities of contracts, you have to sell them on an up move. You cannot possibly sell them as the market's falling, because there are no friends in the stock market. Other professionals will see you trying to sell and will mark it heavily down against you. There are no friends in the stock market. So there's weakness there. There's definitely weakness there on this narrow spread. They've seen that. Now they mark it up here, which they can do, but there's low volume. That's a sure sign that that's a sign of weakness there. It's because professional money are not interested in the bullish side of the market right now at that point. Little bit of hesitation here as it goes sideways. That to me looks as if it wants to come off. Not in the bear market, but just fall a bit somewhat. Although we do have a sign of strength here. It's basic test, is it? And that's why it went up for a couple of bars. Can you put my chart up? The the future.
7 minutes. What time frame do you want?
10 minutes, yeah?
10 minutes.
Okay, that'll do. Now, here we can see we have a 10-minute chart. That means every 10 minutes, right, a bar is produced. Now, there's no reason why we've got 10 minutes. We could use 1 minute, 5 minutes. They all tell you roughly the same thing. Now, the reason why it came off, look, is because we have high volume on up bar here. Markets do not like very high volume on these up bars. Well, I've just told you why. Because if you're a holder of these large amounts of contracts, if you're going to sell, you have to sell on these up bars. And that's why the market, we say, doesn't like high volume on up bars, especially after you've seen an up move. The market is vulnerable. So off it comes a little bit. It's hesitating. Now, of course, professional money need movement, right? They need the market to shoot up and down. They'll come out with any sort of rumors, any excuse to mark it up or down, but you cannot believe them. If you start believing, then you'll probably never make it. You've got to be highly suspicious of more or less everything. But that's what we call a shakeout. Basic test look. And it's the reason why here the market's gone there and gone up, because of this. As a test. Now, the principle that we're looking for here, because the markets move on supply and demand, we can see here at this point the amount of volume, which is not high, looks quite low actually. The market closed near the high. So we assume there must have been quite a bit of buying there. Now, before they move up, they have to be extra cautious, and they have to do what we call a test. That area, you will expect a test back down into this area. If I draw a line here, look, slap bang in the middle of that bar, look, then as the market moves over, you see we have here what we call a bottom tail lunging down back into that level. It's the level that's important. And if you look at the volume, it's quite low, look. Now, when you see a down bar on low volume back into the area where there was higher volume, that's telling you that supply has disappeared. They are not selling. Right? If they're not selling, professional money must be bullish at that moment. They must be anticipating higher prices. Now you see this constantly, practically all the time, and that's a VFA principle to look out for. A test back down into the same level, it's a level or area. If the volume is low, then that's going to go up. As soon as you see that, you would expect higher prices. I'm not saying a huge bull market, but you get higher prices. Don't forget my view is usually for scalping purposes, and that's why it went up like that. Are there any questions about this chart? Rita's sitting here staring at the screen. She can read out anything you type in.
There's a question here, why is a test enough to move the market up? Yeah, there's a question here, why is a test enough to move the market up?
Actually, I told you that, the answer to that question about a minute ago. Markets move on supply and demand. The biggest danger to a professional player is that he backs the wrong direction of the market. And the wrong direction is when there's supply present, when other professionals are selling. That could swamp his move. And that's why they test the market. That's why you see tests. That's the reason. And you can see for yourself, you look through these charts and look out for these tests. On mine, I've got the down bar colored in red. Basically, a test is a red down bar, narrow spread, close in the middle or high, volume is less than the previous two. And that's because we go by relative volume. We don't go by any numbers or anything like that, or on balance volume, all that nonsense. We don't follow that at all. What we look at is what we call relative volume. If the volume is less than the previous two bars, then relative to the two bars, previous two bars, right, there must be low volume, low supply. Does that answer that question? Very, very important. Testing.
Okay, Gavin, are you there?
I am indeed. Yep.
Over to you then.
Yeah. Okay. So stay with us, Tom, because we'll probably got some more questions coming in for you. All right. So let's go and take a quick look then. Got quite a few questions about why I still think gold is going to go to 1,000 and the reason for that. We'll talk about that. Okay. So let's have a look. First of all, though, we're going to do a look at natural gas. Now, this is a futures contract. Some of you may be familiar with it. In fact, let me ask, how many of you here trade the natural gas futures contract? How many of you trade natural gas? How many of you trade natural gas here? Let's just ask the question of the audience. Okay, quite a few of you saying no. Yeah, it's very volatile, Emmanuel. Yeah. All right, well, we'll start with a trade setup that... Oh, just bear with me a sec, 1 sec, and I'll explain this. Okay, sorry about that. So let me just explain the setup here that we sent an alert out on yesterday, in fact, or day before yesterday, which was a short on natural gas. But can I just ask our trading... Hello, Jordan, good to see you. Great, it is recorded. We are recording this, yeah, and we will archive it. Can I just ask you all, first of all, for those of the Trading the Markets members, how many of you, can I ask, got the alert for the short on natural gas that we sent out yesterday? Can I just make sure you all got that? And I actually took this trade myself. Okay, so you have to be subscribed to the futures. You've got, okay, most of you got it, yeah. Okay, question from G. Taylor. Is there ever going to be a part of the site to show what type of performance or gains are happening? Yeah, absolutely. Yeah, you can go down when we update them. They're all updated. Okay, down here you can see for yourself what happened. It says yes or no. Okay, it's all updated. Some of them are still running. Some of them are still in progress. But yeah, the website will show you exactly what the market did, where the market went. It's all there. Absolutely. Good. Okay. When it talks, I mean, someone, G tell you something about percentage gains. What are you referring to? We've got over 1,000 members of Trading the Markets, and some of them are trading $1 million, $5 million accounts, and some are trading $2,000 accounts. Some are getting 3, 4, 5% in a trade, and some are getting much more. Some are losing. What do you want me to put up there? You know, you can't put a percentage gain for a group of 1,000 people. Everyone is looking for the principles, which is what we teach you. And let me show you, let me give you an example. I mean, it's the best way to show you this. If you look at the natural gas alert yesterday, okay, the first thing you do is you look at the video. That's what we're asking you to do. We're not telling you where to buy and sell. That's not our job. We're showing you where a principle has appeared using the VSA principles that Tom has taught me. You can see here. Hi everyone, welcome to Trading the Market. Okay, you can see here very clearly, right, there is a principle, and let me teach you it. First of all, we're in downtrend, as you can see in the video. We've got supply coming in, number 78, and I'll give you the numbers of the indicators. So it's very important that you look at the indicators on your software. Most of you have the software if you're a member of the Trading the Market service. And then at this point, you decide, based on your account size, not my account size, your account size, what position you, if you're going to take any position at all. And again, as Tom and I have always said, we're not going to tell you and preach to you that we're making 80%, 70%, 100%. That's nothing to do with this. We're teaching you the principles. You then have to learn, and it's important you learn, how to manage the trade, manage the risk on the trade, and manage your own account. Some of you in this room have got $500 accounts. I know this because you've spoke to me. Some of you are trading $5 to $10 million accounts. How on earth can I tell you which way to put a stop? I wouldn't try. That's not the purpose of this service. The idea behind it is to identify the principles. Let's have a look. It says what you look out for. You wait for the 4-hour bar to close, and if it closes below 4120, that would be a gotcha bar. And then we're going to look for ultra high volume bars forming or no demand bars on the 60-minute chart. So let's look at now what actually happened. Mark, please do. Mark, you're a valued customer. I just saw your comment there. An update on the alert. I meant something I'm looking into. That's a good idea. But we tend to do these updates in the forum we're in right now, which is where we show what happened to the market. So yeah, but please, any feedback, gratefully accepted. So first of all, let's talk about the start of the trade. I've done 2 trade alerts to short natural gas based on what happened here. All right. Now, I never ever thought that as a market was going up on very high volume until I met Tom Williams, that there would be selling involved. But we can see clearly here on these 3 bars principles that if you just learn this tonight and you identify these 3 principles, you will realize how the markets get marked up deliberately, almost like an auction house. Tom, when I sit with Tom, he often says, well, so imagine you're in an auction house and they're trying to sell something. What do? Do they bid it lower? Do they say it's going lower, going lower? No. They say, who's going to give me £5? Who's going to give me £6? Who's going to give me $4.8 for gas? They mark it up. And that's done quite deliberately. And the general public don't understand it. But here you have what Tom taught me was weakness. Ultra high volume on an up bar, followed by a very narrow spread, but on very high volume, the highest we've seen. The following bar confirms the weakness. It confirms the weakness. It says quite clearly the market here is not going to go any higher, but we get this bar, and they're done deliberately to catch everyone out. They're called up thrusts, and they're done quite deliberately. After you see these bars, you're very tempted to want to, if you're a VSA expert, to try and get short. But of course, the market doesn't change behavior, in my opinion, until we take out the low of that bar, and that's what happened here. And we call that a gotcha bar. It's a serious sign of weakness. Okay, serious sign of weakness. And on that one sign of weakness here, when you see it, we then look for other signs of weakness for confirmation of what's happened over here. But you see, you may look at it and say, well, what happened on the 12th of June is irrelevant to what happened on the 26th of June. But it's not. Unfortunately, it's totally relevant. So let me bring Tom back in. And the question, Tom, which I know confuses many people with volume spread analysis, is why can these 3 bars here be at all relevant to a no demand bar that happens 8 days later? What is the logic behind that? Over to you, Tom.
Yeah, I can't actually see his chart. I can only see my own. The problem is I've got macular degeneration and I can't see the charts, but I can see up to about 20 bars fairly well. But I can't see these long strings of bars like Gavin's got up here. Not in detail anyway. But the thing is, whenever you see ultra high volume on an up bar, especially if it hits that top trend line, especially if there's already had a decent rally, bullish move behind you, right? If you see ultra high volume in up bar, you can bet your bottom dollar they're selling, and that's what's causing it. That's what causes the ultra high volume. There's probably been some good news or whatever, euphoria of an up move. People come rushing in, even banks, they're not much good, most of them. They come rushing in and buy right? But the professional money want to unload. So they unload into the buying. At the same time, they're probably shorting, right? And this is what causes the ultra high volume. Now, if you listen to the TV, I was listening to it once, and the commentator said, oh, well, there you are. It's gone up, look. High volume, so that must be all buying, right? It's got to be buying. I mean, that's why it's gone up. Look, high volume, that's why it's gone up. What else can it be? And if you're not careful, right, you'll fall for all this. And that's what I mean by when I say that you will easily have difficulty in getting your head around this, because the information that you are getting from the media, from your broker, from the guy next door, and so on, right, is misleading you. You cannot really believe anything you see or read or hear about the stock market, because it's there, manipulated by professional money. They bully their way into the market with huge amounts of money, and of course they sell. When they sell, they have to sell on good news, on up bars. I can't see the chart any further. Can you put the S&P up weekly?
Tom, just so you know, I just wanted, the question I was asking you, just to be clear, you don't need to see the chart. It's actually very clear. Everyone can see it. Is we've got massive volume on up bars, but the question I asked you was, in the future, sometimes it can be weeks or days into the future, if the market goes back up into that area where the ultra high volume bar was, and now the volume is extremely low, it's very important, right, when you're shorting the market, because it's telling you there's no demand. Do you want to explain no demand after weakness to the new people here?
Right. Now, getting back to, you can't believe anything you see or hear or read about the stock market. What Gavin's talking about is what we call no demand. Professional money are sitting there fully aware of the weakness in the background. Ultra high volume and up bars. However, they're a devious lot, and what they'd love to do now is to catch a load of stops, which is very profitable. Remember, above and below these actively traded markets, there are not hundreds but thousands of stops. It's very lucrative to catch as many as you can, right? And also it encourages people to go in and trade, in this case no demand, in the wrong direction. So imagine you are in an auction house, right, and you're an antique dealer, and there's lots of other antique dealers in there, and some item comes up you know is worth about $1,000. That's it. But when the auctioneer appears, his job is to get as much as he can from the participants, the audience, in other words. So he may say, I've got this fantastic antique here, right, who's going to offer me $2,000? Now, if you're a professional player, you and others there, you know perfectly well that's only worth $1,000. So there's no way you're going to bid at these high prices. So what do? You sit back and do nothing. Now, if you were charting that on paper, right, you would see the price go up as the auctioneer marks it up. But the volume, when you drew that in, would be low, because the participants, the professional people who know what's going on, are not interested. And that's what we call no demand. It's a very, very certain sign of weakness, and you see it all the time. And you read all these bits of information, just like a story out of a book, and you'd be surprised how accurate opinion you can come to of what the market's going to do, which is what we love to do here in the office. We love to do a bit of scalping. We find that far more exciting. We have a professional fund manager called Philip Tristan who specializes in longer term. So if you've got any questions about any longer term, he's the boy to talk to about that. He's very good at these 5-year bonds and all this stuff, which I don't know much about, I must admit. So that's no demand. Now, can you put my weekly chart up?
Right, thank you, Tom.
Of the S&P 500?
Yeah, yeah, I'll hand over to you, Tom. If you want to take the chart back.
Okay, and I've got Gavin here. He's twitching all the right knobs and doing everything. Rita's there. If you've got any questions, please type them in and she'll read them out. Weekly. That's a Dow. Well, you could leave it like that. Right, this is a weekly chart of the S&P 500. Now you can see we've got this fantastic run up here. It's dotted with all these red bars, which is testing the market. Right. Now, here we have the real first sign of weakness. Weakness, when it appears, will appear on up bar. And this is an example of our no demand. The auctioneers marked it up, look. Professional money can see that markup. They say, well, you carry on, mate. I'm not interested. Right? And we know that because look at that volume here. It's low. Volume is relative to the previous bars is low on that markup. That means professional money is not interested in the up move. And that's a sign of weakness. It's not saying it's going to mark the end of a bull market. It just means it's probably going to have a reaction here. We can see these trend lines. Now it's very important to spot that. Okay? Any questions about a chart like this? Can you put a longer time frame up? Well, 40 bars or something. That's it. Now that's a longer chart, look. And you can see that the daily chart is littered with what we call shakeouts. Yeah, weekly, sorry. Weekly charts, look. This is a ploy for higher prices. Right, basic test. Well, it's also a shakeout, look. We call those shakeouts. When you see these violent moves down below the lower trend line or below the line and it closes up near the high, you have to assume that's a shakeout. And you can see the volume has increased considerably. It increased because they're buying, look. Right, now they will want to test it. So off it comes, look. Red down bar, look. Relative to the previous volume, look. It's low, lowish. Relative to this, look, the high volume here. And that's why it's gone up like that. But we've seen the first sign of weakness up here. First, no demand. That bull market's been running for some time, this weekly chart, as you can see. But they seem to love these shakeouts on the way up. Look. Yeah.
was a question here. Do you expect the market to move down now to the bottom trend line or not yet?
Well, you can anticipate something, but reading these charts, it's like reading a story in a book. You have to wait for the chart to develop to see what's going on. The market now is considerably what we call overbought, and there is no demand there. You would expect to hit that trend line at least. That trend line there. But it's Friday, right? They can be very devious on a Friday. You have to be extra careful. But the best day to analyze these markets is Monday or come Tuesday, because there's a large percentage of professional money. They go home tonight, Friday, and they've sold everything. They have no holdings whatsoever. That means they can sleep at night and not worry. But that means that when they arrive Monday, they like to, if they want to know what the market's, which way to back it. And they frequently, if it's bullish, you'll see a test on a Monday or sometimes on a Tuesday. If you see that, you can bet your bottom dollar you're going to get higher prices. Now that may occur next week. We just have to let it unfold and see what happens. But that's how you scalp the markets. That's how you read the markets. But once you've mastered it, you'll never ever regret it. But always keep in mind they're a devious lot. They're not there to help you. And they will put out false rumors. They do all sorts of tricks. I mean, apparently there was weaknesses appeared in the S&P 500 because there was trouble in the Portuguese bank. Now, what on earth a Portuguese bank has to do with 500 stocks in the S&P 500 remains to be seen. News appears sometimes to move the market, but it doesn't. What happens is professional money force the market in different directions on the news, which, let's face it, if you're selling a second-hand car, you come out with all the good news. You don't come out with any bad news because you're trying to sell it. But on the other hand, if you want to buy it, then you may look for negative stuff from the buyer. It's the way human beings work. But it's very easy to get misled in these markets, very easily. Always be pessimistic about what you hear. Be quite honest, I've never ever heard in my life any accurate information about the stock market. Never. It's usually completely wrong. Anything?
You there, Gavin?
I am. Peter, let's wrap up with crude oil and Quindel. I think the two charts that show everything that Tom has just said to the audience confirm basically that everything you think that should happen to a market never goes in the direction that you think it should. And so what I'll do, Peter, I'll take the chart and keep Tom there though, because I will get him to sum up at the end for the people that are new, and then we'll wrap up in a couple of minutes. But here is a chart. Now I'm using my scanner here. Can everyone see my chart of crude oil? And there was a few signals and a few clues in this chart on the 4-hour chart that crude oil was going to fall, which was what we forecast. Rock's asking, do you wait for a no demand bar to be confirmed by the next bar closing lower? Yes. Yes, that's correct. Yeah, okay. So here is crude oil. Now, a few weeks ago, in the VSA Club and in our Trading the Market service, we forecast that crude oil would look weak, and the reason we said that was based on this chart, but not just this chart, it's based on the scanner. Now I'm going to show you the scanner. Now I'll just ask you all, as people looking at a screen here, what is the majority of the color of the blocks on this chart? Is it red, green or grey? What is the majority of the color of the blocks on this chart that you're seeing? Just want to make sure that I'm being a bit pedantic for a reason. And this is, I know many of you are saying, of course it's red, it's obvious. I'm just checking because there are a lot of you here, and some people come up with comments you're like, hey? So I'm just checking. Do you all agree that the 5-minute, 15-minute, 60-minute, and the last certainly 5 hours, and the big time frame, the biggest time frame I use on crude oil is definitely red, which means it's trending down? Let me ask you, do you all agree with that statement? Is that an acceptable statement to you that you will agree with? Okay, so everyone's saying yes, because you can't. Anyone that says no shouldn't be trading. Now here's the 4-hour chart. Okay, now we notice this is the Infinity AT platform that I'm using. I'm using a scanner. Now, does anyone notice any unusual volume on this chart? And there's 3, maybe 4 places I see it. But is there any, can you see the volumes at the bottom, which is the number of orders going through the exchange? Does anyone see any unusual volume activity here on this chart? Remember, we're trending down. Okay, I want you to study this chart very closely now, because what I'm going to teach you right now will help you massively to read markets. And I know a lot of you are new. We've opened up our Trading the Market service to the public tonight. Okay, good, good. Second question. Looking very closely at the dates at the bottom of the chart, which I'll highlight for you. I'll put them in a spotlight here. I'm looking at the dates. From the 15th of June, this is a 4-hour chart of crude oil, 6th, 17th, 18th, 19th, 20th, all the way here. When we refer to volume spread analysis, the spread part is the high and the low of the spread or range of the bar in the time frame we are analyzing. I'll ask you all a question. Where do you notice the biggest spread or range of a price bar on this chart? And look very closely and type in. I want everyone to contribute, please, and you will learn something now that will definitely make a difference to your trading, I promise. Now remember, the ranges of the bars are here, 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 here. I want you to tell me where the biggest range or spread. Look very closely. Look again. If you're not sure, look again. The widest bar possible. I want you to tell me where it is. Okay, some of you are not getting it right. Look again. The widest range, a very important bar on this chart. Look closely at the chart. The chart doesn't lie. Okay, now some of you are getting it. Okay, I'll give you all a clue. And it's really obvious if you look. And again, with trading, I've learned if you're observant and you focus, you see it. Look at the high of the bar here and look at the low of the bar here. That's it on the chart. It's a lot of bars I'm putting up. I'm doing that deliberately because I want to show you what happened. Look at the range here. Okay, do you all agree with me? Again, I'm talking like an ex-policeman, but I will. Do you all agree that that's the widest ranging bar on this chart? Yes or no? Do you all agree with that statement? Imagine You're the jury, and I'm just the police officer, Sherlock Holmes, giving you the evidence. Okay, so everyone says yes. That's right in front of your eyes. There's a red signal on it. Okay, now if we go forward, we could actually see what happens moving forward. There's a red signal on that bar. It's one of Tom's signals. And as Tom always taught me, you ignore them at your peril. That isn't no demand. I've got to just move that forward a bit. There we go. It's there. I can't quite, unfortunately, get that signal up, I don't think, because of where it's at in the chart. But anyway, that's supply. Now, watch what happens. The market changes behavior. How do we know that? Because the diamonds in the system turn red and the bars turn red. Now, I'm now going to ask you the next question, and we're going to focus now not on the price bars at the top. We're going to focus on the volume at the bottom, which is now highlighted by my highlighter. Again, I ask you, where do you see the highest volume coming in crude oil on this chart? Where do you see it? And if you miss this, you shouldn't be trading, guys, sorry, because this one jumped out at me like a sore thumb. Okay, thank goodness for that. Good, excellent. Yeah, you're right. Yeah, okay, so everyone got it. It's here, okay, right here. And if I hold down control, there we go. That's it. That's what I want. This is one of my favorite setups that I'm about to show you. And I'm sharing it with the public here. It's a great setup. One of the things you look for with volume is you look for the unusually high volume activity. I call them Yao Ming bars, and let me tell you why. When I was taught by Tom to trade, I looked at volume. I said, well, what does it all mean? He said, well, imagine volume, which is at the bottom of the screen here, is human beings all lined up in a row. I said, okay. He said, imagine, again, in your mind, that you're walking down. I lived in Chicago for many years. I'm walking down Chicago. I'm on the lakefront, and an alien lands next to me, has never seen a human being. And he says, Gavin, because he happens to know my name, how tall are you? Now, that's an interesting question, because when you look at someone who's tall or short, you have to make a comparison, don't you? So here he says, imagine that this is Tom Williams, there's Peter Offen, let's say that's Gavin, that's, this is my daughter Olivia. They're all different heights, And Rita, I don't know how tall Rita is, or Dallas, who's Tom's girlfriend. But ultimately, when we all stood in a line, if you put 20 human beings in a line, you can see an unusually tall person. Now, this particular bar here, I call it a Yao Ming bar, because Yao Ming is in fact a human being who is 7'6" and used to play with the Houston Astros or the Rockets, I believe, and is a basketball player or retired now, and he was the tallest. And I always said, well, look, if an alien needed to look at a comparison of all these human beings, the alien would look at this bar here and say, my goodness, there's Yao Ming. All the other human beings are pretty tall. There's a couple here. There's probably, well, you probably know better than me in America, some of the tall basketball players, but that is definitely a very tall bar. The volume is the activity. That's all I care about. But look at the price bar. Okay, look at the price bar closely. Where does it close, everyone? Okay, the close is the green tick. Does it close on the high, the middle, or the low? Where do you see it closing? Would that alien... Thomas, I can't repeat that in the seminar, but it's a great comment. Thank you. Where does it close? Where does it close? And remember the green tick that you see, the little green line, if you can see it, I'm trying to I can't blow this up at the moment because I'm trying to focus on the bigger picture. But I can tell you it closes right on the low of the bar, and the next bar closes lower. And if you read the dialog box, which we should do, it always tells us, all of the dialog boxes in TradeGuider tell us what to look out for. This setup shows weakness. What does weakness mean? It means prices are going to fall. Simple as that. Just like we saw in natural gas a few days ago. Now, the calamitous price drop was confirmed again. I mean, professional money are very, very, very generous when they're starting to move the market down. They give these clear principles. Look, and by the way, you can see this in TradeGuider differently. I mean, if you can't see it in that particular screenshot, maybe I'll show you it here. It'll be absolutely. Now, let me introduce you all to my daughter Olivia, who's learning to trade, and she really is. Now, daughter Olivia, if you'd like to say hello to the audience.
Hi.
Tell them your name.
I'm Olivia Holmes.
Okay, and you're going to learn to trade the markets, correct?
Yeah.
Right. Now, what do you...
I'm going to
Hold on, let me just show you something, okay? Because again, this is important with young children, and I'm sorry if I'm bringing my young child into this, but it's important. Olivia, how many colour bars here that you see are red compared to the blue ones? Is there more red than blue?
More red.
Okay, so do you think the price is going down because it's red or up because it's blue? What do you think?
Up because it's blue.
It's up because it's blue or down because it's red? Because it's going...
Up.
You think...
Because purple.
No, look at the...
Down
now,
because it's purple.
right, that's good. Down because this one's purple. Now that's what I've taught her, is that actually when a purple bar appears, which we're seeing right here, she is seeing that the price hasn't closed yet, but she is noticing that there are red... Now can you, Olivia, look at this signal here? Okay, what colour is this?
Red.
Okay, that's good. Now what does that mean? It means down, yes?
Yeah.
Now, if you see a green signal, what does that mean? Does it mean it could go up or might go up?
Might go up.
Very good. Now, thank you very much, guys. You can go. I mean, I'll be down in a... What do you want to tell me?
Me and Ruby went to the park, and at the end we got a toy to have.
Can I finish my seminar? Thank you. And I'll be down in a minute. So, but on a serious note, guys, I mean, seriously, my daughter Olivia, when you show children colours, it's very interesting how they note certain things. And what I've been trying to do with VSA is to simplify it, because some people find it complicated. Now, to simplify it, I read an article several weeks ago that said, if you cannot teach a 5-year-old child what you're doing, then you may be complicating the issue. So even though you just heard my 5-year-old daughter talking, please rest assured that's a scientific experiment in progress, because if I can get her to understand direction of price based on principles, then I know I can get you to see the same thing she's seeing. And I'm quite encouraged by what's being seen. So let's go back to the chart. What I'm asking her to look at is, do you see high spikes in this chart? Yes, you do. Then there's no doubt they're there. Do they have red signals on them, or do they have green signals on them? They have red signals on them. The lesson I'm going to teach you tonight, ladies and gentlemen, is these trap up moves are done deliberately, and they're consistent. And hopefully Tom can just finish on that signal, because he doesn't talk about it very much. I mean, I don't think I've heard Tom talk about sign of weakness 58 very much. And when I'm with him on Sunday and Monday, we're going to focus a lot on this, because when you see that signal, the market very often will give you a trade if you put the stop on the top of the bar. But here's the key thing. It seems to me it works best, for some reason, on a time frame over a 1-hour chart. That's just a personal observation. So even a caveman can do it, said Jim. That's right. That'll be our next marketing thing. Volume spread analysis. Even a caveman can do it. Talking of cavemen, Tom loves to talk about them. Tom, finish off with this particular signal and I'll wrap it up. The trap up move, what's going on here? And this works brilliantly. What's your thoughts? Okay, it looks like we lost Tom for a second. Yeah, I don't know. I think we lost his sound. You there, Tom? Yeah, I think his internet connection
With the
went
close lower.
Can you start again?
Right.
Problem with the computer.
Right. Okay. Start again. Right. Okay. Yeah, a trap up move is you see the market suddenly go up in a wide spread, closing on or near the high. The next bar, however, is falls and a wide spread, and the close, a serious top reversal, is closes then lower than the lower the previous bar. We call this a top reversal, a trap up move, and it's a really serious sign of weakness. The market then hesitates. Professional money are fully aware of seeing that, and they're liable to have then what we call an up thrust or no demand up move. Up thrusts, a devious affair. The market deliberately marked up, right? But it catches thousands of stops above these markets, actively trading markets, right? And then it also not only catch stops, but encourages people to go long. There's a lot of people out there, what we call chase the markets. We don't recommend you ever chasing the market. You can only trade on a principle. And then that up thrust or no demand up thrust after we've seen that top reversal, that's a serious sign of weakness. Do you want to look at the
okay,
S&P?
thanks. Thank you, Peter. No, appreciate it. Yeah. No, I think Tom. I think we're pretty much there. We're almost finished. Michael's asked a question. When comparing the ES futures chart with the S&P cash index of the same time frame, which volume bars do you find more beneficial? The reason I ask is that occasionally the volume at the same bar time frame of each night might be different. Thanks. And that's from Michael. So Tom, what he's asking is sometimes the cash and the futures volume may be slightly different, which it can be because we know they position themselves in the futures market in the next day. Is there any reason that you'd be concerned that the volume would be different the night before in the futures and the cash, or do you believe, Tom, that the cash leads the futures?
Well, what I do know is the cash market, that's the S&P 500, is where the equity of the market lies, and the future is a derivative of that. So I would believe the cash market first. But remember, the guys that are active in the cash market also trade the future. And believe me, because they're a devious lot, they're not above moving the future market first on anticipating. They know they're going to take a certain amount of action in the cash market. But the S&P 500 and the Dow, that's why you need to look at the end of day S&P, the Dow, and the NASDAQ for a pretty good opinion. Sometimes it's very, very clear, and you can make quite a bit of money trading the end of the day because sometimes it's very, very clear. Okay?
Yeah, indeed. Thank you, Tom. Good. Okay, so we're nearly out of time. Is there any Tom's chart of the S&P 500 that has volume? Okay, Tom. The question from Ramaya was asking, your S&P 500 chart actually gets volume on the cash. I think you can get that from Metastock, I'm pretty sure, but you do get cash volume on the cash, correct?
What was that, Peter? Can you get volume on the cash market?
Oh, yeah. Yeah, no problem there. You can definitely get volume on the cash market. I mean, I have it all the time. But that's where you really need to start your analysis from, is carefully look at that daily chart. And we saw when we looked at the Dow earlier on, yesterday, it was up to date to yesterday, it looked a little bit like a test, didn't it? So you would expect the market to try to go up today on the back of that. But as you keep concentrating and reading these charts, you'll see they are readable. It's fascinating. Once you get a breakthrough and you can learn to read these charts, you'll be very, very happy trader, because the whole veil of mystery will be lifted. But don't listen to anybody. Don't listen to the TV. Don't listen to your broker. Believe me, the truth lies in the chart.
We can see that very nicely. You mentioned, Tom, that you thought the market was going to go up, and indeed it's, as you can see, several of your signals have appeared, and it's rallied, which is good. Okay, gold has been going up lately, but do you think it will go down? Not yet, sure. I wouldn't be short gold yet. They'll upthrust. You'll know the signal will be very obvious when gold's going to come down. Very obvious. Today and yesterday, the market was marked down, as we all saw. I mentioned that in the email last week. Most of you would have got it if you were on our database. It was very clear. It was clear because of a principle. Markets get marked down deliberately for more buying. I believe, as Tom does, and I think he's right, that the market could push a little higher here, because the market here, the fall that we had was immediately reversed. And you ignore the VSA signals at your peril. Okay, good. So Tom and Peter and Rita and Dallas, thank you very much indeed for your contribution. I hope a lot of you are new. I know some of this is going to take time to digest, but what we have done, if you want to go and look at the video that we've put together on market manipulation, our new site is just being developed, but it's marketmanipulation.com, and there's a book on there which you really want to look at, and I'll put it in capitals so you can all just type it straight into your browsers. It's just marketmanipulation.com. Register from there. Go and take a look at the video. It comes in. There's no charge for that. That video was originally on our website for $300. Take a look at it. It'll show you why volume is absolutely vital to the professional trader and investor, and really why you must understand that strength appears on down bars and weakness appears on up bars. And that was a valuable lesson that I learned, and it's never, ever, ever held me back. And I hope it won't hold you back. So from all of us at Trade Guide, from the VSA Club and TradingTheMarkets.com, from Tom Williams, myself, and Rita, Peter, and Dallas, and my wife Laura, and of course Olivia, who's trying to learn to trade, thank you very much indeed. Have a great weekend. We'll see you all next week for some live trading in TradingTheMarkets.com. All the best. Take care. I hope you learned something tonight, and have a great weekend. Bye-bye.